Now what we want to consider are advanced variances. I would strongly advise that you are fully conversant with basic variance analysis before you look at what we're about to do. I want first of all to look at two specific issues. One is planning and operational variances, and the other are material, mix and yield variances. When we look at planning and operational variances, we're looking at a specific issue, and that is that standards may become out of date. You see, the issue with the preparation of standards is when they are prepared. We prepare the standards for, say, this year at some point in the previous year. And because standards are a fundamental building block for the budget, they're probably prepared somewhere near the beginning of the budget. So typically they will be prepared maybe in April, May, June of the previous year. Of course, it is possible that those standards may become out of date. And if they become out of date, using them to calculate variances is not very helpful. Our solution is to revise the standard, update the standard for the fact that things have changed. But we must be careful about this. If we're not careful, we'll be put under pressure by managers to update standards on a regular basis. Because if they can make the standards easier, then when it comes to the evaluation of their performance, it will look better. So we have to be aware that any change of standards is a highly political issue. So let's see how this works. Traditionally, we would compare the original standard to the actual result. Fine. All we're going to do now is to introduce a revised standard. Now, the revised standard allows us to prepare a planning variance. Now, the planning variance is, if you wish, due to planning error. Now, what is planning error? Does that mean that we got the standard wrong to begin with? Well, the answer must be no, because that would suggest that we as accountants made a mistake, and we never make mistakes. So, when we talk about planning error, the whole idea is that it's about change over time. You know, we were correct when we first prepared the variance, but things have changed. Now, the most important thing about planning error is this. From the perspective of the manager in charge of this variance, it must be uncontrollable, beyond their control. So, for example, we could say, if we were talking about the oil price, that's beyond the control of a manager. Or a dramatic change in the exchange rate, again, beyond the control of a manager. The whole point is that we're trying to isolate the planning error. If we can isolate it, get rid of it, then we can focus on the bit of the variance that we really want to look at. In my view, this is simply a reconciling item. It just makes sure that it all adds up. We're not very interested in it. Given that we've got our planning variance, we then compare the revised standard to the actual results to get the operational variance. Now, this should now better reflect operational factors. If you wish, it will reflect management actions, what they have done. And because we have isolated planning error, managers should be more willing to accept that this variance fully reflects their good or poor performance. The assumption is that this is controllable. Of course, we don't know about that, but in the first instance, that is our assumption. So, if we are trying to decide whether we wish to accept a planning error or not, what we have to do is to focus on this area. Something that is within the control of the manager should not be allowed as planning error. Something that is outside the control of the manager could be allowed as planning error. The only other thing I would add to this point is this. not only should the planning error be uncontrollable, but also we could also argue it could be unforeseeable. Because some things may be relatively obvious. For example, we would always expect that there would be some sort of inflationary rise year on year. And if the manager did not pick up on the fact that there should be an inflationary rise, well, it's really their fault. So what we're looking for are major and dramatic changes to what was the original standard. Something that they could not have foreseen, something that they could not have controlled. So I've focused quite a lot here on the discussion part. And I would strongly advise that you pick up on these pointers just in case the examiner wants you to discuss around the issue, something that has happened in the past. Well, okay, so how do we deal with planning and operational variance questions? Well, I have a very simple technique. What we do is we start with the basic pro forma that we know and love for materials. Standard quantity, standard price, actual quantity, standard price, actual quantity, actual price. If we now go back to what we just talked about, what I like to say is this. Originally, we were comparing the original standard, or to me, just the standard, to the actual result. If we now look at the planning variance, what has changed? Well, in simple terms, where we had the actuals before, we now have the revised standard. So my argument is this. We use the original pro forma, but we substitute actual with the revised standard. Very simple. So let's see how this works. We substitute the actual with the revised standard. Standard quantity, standard price remains the same. Actual quantity, revised standard. Well, what did I say? I said substitute the actual with the revised standard. So where we had actual quantity, we now have the revised standard quantity. And when we have actual quantity, actual price, well, of course, we substitute the actual with the revised standard. We end up with the revised standard quantity and the revised standard price. Very simple indeed, I hope. When we come to look at the operational variance, we have a very similar issue. Remember, the traditional analysis is we compare the original standard to the actual result. But of course, when we look at the operational variance, we compare the revised standard to the actual result. So can't we simply substitute the original standard with the revised standard? As simple as that. Let's see how it works. So what we want to do is to substitute the standard with the revised standard. So where we have standard quantity, standard price, we now have revised standard quantity, revised standard price. Very simple. Where we have actual quantity, standard price, we have actual quantity, revised standard price. And where we have actual quantity, actual price, nothing changes. So, very simple indeed. All I want you to remember is this and this. And if you can do that, you can easily calculate any variance by taking the basic pro forma that we always use and adjusting it. By far the best way of doing things. Let's look at an example to see how things work. Now, first of all, let's just look at the basic variances that we know and love. I think we can slot it in up here. Standard quantity, standard price. Actual quantity, standard price. Actual quantity, actual price. So let's just make sure we can do this before we go any further. So compare the top two. We're looking at the usage variance. And comparing the bottom two, we're looking at the price variance. So, standard quantity, standard price. Well, we expect to use 3 kilos per unit. And remember, standard quantity is short for the standard quantity of actual output. The output is 12,500. We multiply by the standard price, 5, And we end up with 187,500. Actual quantity standard price. Well, the actual quantity of kilos used was 38,000, and the standard price was £5 per kilo. So we end up with 190,000. And actual quantity, actual price, we just take the actuals, 195,500. Top minus bottom. The usage variance is 2,500, adverse. The price variance is 5,500, adverse. Wow, doesn't look particularly good. Now, I've calculated the variances. Now just let's look at the requirement more carefully. Prepare the variances using basic variance analysis, fine, and assess whether the purchasing manager and the production manager individually have done a good or bad job. Well, okay, I suppose that the purchasing manager will have something to do with the price, and the production manager will have something to do with the usage. And what observation can we make here? Well, it appears that both managers are doing very poorly, and maybe we should be asking them to look for a new job. Okay, so there's our basic analysis, just to get some numbers out for fun. Now let's look at a planning and operational issue. Okay, so if we go further, let's read on. After further consideration, the standards have been revised to reflect changes that have occurred over time. The standard usage is now expected to be 3.1 kilos due to a poor harvest leading to poorer quality material inputs. Okay, is this uncontrollable and unforeseeable? I think the answer is yes and yes on both counts. We can accept that. In addition, due to adverse movements in the exchange rate, the material costs have changed. It is now expected that each kilo will cost £5.15. Well, okay. So what we want to do is to do both the planning and the operational analysis. And once we've done that, assess the performance of both the purchasing manager and the production manager. So if you remember, our basic pro forma was this. Standard quantity, standard price. Actual quantity, standard price. Actual quantity, actual price. And I said to you that wherever we had actuals, we now want the revised standard. So in simple terms here, we're going to take all of these actuals out and have the revised standard quantity, standard price, and the revised standard quantity at the revised standard price. Compare the top two, we get the planning usage variance, and compare the bottom two, and we get the planning price variance. You could argue that we don't need the detail. We could just get an overall variance here, but I don't think it taxes us that much to do just a tiny bit more. So, if we're looking at our planning variances, so now let's just introduce the numbers. Standard quantity. The original standard was 3 kilos per unit. And of course, standard quantity is short for the standard quantity of actual output, 12,500. We multiply by the standard price, which was 5. Revised standard quantity. Well, the revised standard quantity is 3.1. And again, we multiply by 12,500. It doesn't matter whether we're looking at the original or revised standard. They are both in relation to the actual output, multiplied by the standard price of 5. And revised standard quantity, revised standard price, 3.1 multiplied by 12.5. But the revised standard price is 5.15. Okay, so what do we get? We get 187,500, 193,750, and 199,563, rounding up. To get our variances, top minus bottom, not difficult. So we end up with 6,250 adverse. Top minus bottom, we end up with 5,813 adverse. Does this mean that we should be sacking our managers? Does this mean that our purchasing manager and our production manager have done a bad job? Well, the answer is no. When we look at the planning variance, this is the uncontrollable element. So from that perspective, it does not show whether the manager has done a good or bad job. All it shows is those bits of the variance that are due to other uncontrollable factors. So we take this variance and throw it away. We don't want it. In simple terms, we calculate the planning variance as a reconciling item. The only bit that we're interested in is the operational bit. So now let's look at our operational analysis. If you remember, our original pro forma went something like this: standard quantity, standard price, actual quantity, standard price, actual quantity, actual price. What was the rule with operational variances? Everywhere we have a standard, we now want a revised standard. So all we do is to update these by having revised standard quantity at revised standard price, actual quantity at the revised standard price, and there we have it. So, if we compare the top two, we get the operational usage variance, and the bottom two, the operational price variance. So, do we have revised standard quantity, revised standard price? Well, we calculated it just a moment ago, didn't we? 199,563. Okay. If we now look at the actual quantity is 38,000. And the revised standard price is 515. That means that we end up with 195,700. And finally, actual quantity, actual price, we know is 195,500. We were given that originally. Top minus bottom. Top minus bottom comes to 3863, favourable. Top minus bottom, 200 favourable. What assessment can we now make about our managers? Well, if we look at our managers, couldn't we say that the production manager has done a fine job because they have saved us a lot of money, and the purchasing manager has done an okay job because they are somewhere near, they are standard. A negligible variance that happens to be favourable. So the whole idea of planning and operational variances is simply this. We discard the planning variance in order that we can better understand operational performance. A further area in advanced variances, and possibly the most challenging area for a lot of students, is to look at mix and yield variances. Now, mix and yield is simply a further sub-analysis of the material usage variance. Remember, variances is all about breaking up the variances as much as possible in order to better understand what's happening. Now, you only get mix and yield variances given that you have a mix to begin with, that is 2 or more material inputs. Now, that's not much of an issue because most products have 2 or more components going in. But more than that, it only makes sense to have mix and yield variances if you are able to substitute one material input for another. And this is not normally the case in manufacturing. If you're building a car, it doesn't make sense to substitute a couple of extra wheels but leave out the windscreen, something like that. So you typically only find mix and yield in some sort of process costing environment where there's a homogeneous product of some sort. Now, what I like to do is this. I like to say, let's just not throw everything away that we've already learnt. Because I've said to you that it's a sub-analysis of the material usage variance. So if we look at the old pro forma, we already have a basic pro forma for materials. Standard quantity, standard price, actual quantity, standard price, actual quantity, actual price. All I want to do is to adjust and develop on that pro forma. You see, the way that we separate the variance into a yield and mix component is by adding one further step. We sub-analyse by looking at the actual quantity at the standard mix. If we can get those out, in essence, all we're doing is a slightly more complicated working to what we had before. Now, we have an example here to try and illustrate how it all works. So let's just read the example and try and gather information as we read. Please remember, when we look at any variance question, it's always the same. We would expect up the top the standards, and we would expect down the bottom the actuals. So, Dalgleish manufactures a fertilizer by mixing 3 chemicals, A, B and C. And the following standards apply. So what we are given is the standard proportions or mix. So for every unit that we make, 70% is expected to be made up of A, 20% of B and 10% of C. Then we have the standard costs per tonne. What we pay for it, what we expect to pay for it. During the process of mixing, a process loss of 10% is regarded as the standard. Oh, so for every 10 tonnes going in, we expect only to get 9 tonnes coming out. In week 17, 855 tonnes of fertiliser were produced, and the inputs were as follows. Okay, so that's the output, isn't it? The inputs were as follows. So, we've got the actual inputs of A, B and C, and in total. We've got the actual price per tonne, and we've got the actual costs. So, amongst all of this, we have sufficient information for us to calculate the variances. And what I would like to say more than anything else is this. Too many people get hung up on the tricky part of the question. Can I re-emphasise something that we've already stated? And that is that 3 components we already know about. This one, and this one. And we could easily calculate those components without a second thought. The other thing we have to remember is that we've got to do quite a lot of calculation here. So what I advise is doing quite a large table. If you notice, what I have here is I have the 4 elements that we need, and we're going to do separate workings for each. We're going to get the totals over here, and only then will we even think about calculating a variance. Okay? Okay, so let's start at the bottom, and I want the actual quantity at the actual price. Is that going to be too difficult? Well, I think the answer is no. It's going to be very straightforward indeed. If we go back to the question, here are the actual quantities at the actual price. So let's give it a go. 13,860, 6,720, and 6,110. We could total these, but strangely with this particular number we do not need to total. Now that is very straightforward, and that is laying the foundation for 3 of the marks that you will get straight off in this question. Then we want the actual quantity at the standard price. Well, is this going to be too difficult for us to identify? So what we need here is the actual quantities, which we're given here, multiplied by the standard price that we're given here. Very straightforward indeed. So we have 660, 210 and 130. Those are the actual quantities used. And we multiply by the standard price of 20, 30 and 50 pounds per tonne. So we end up with 13,200, we end up with 6,300, and we end up with 6,500. So if we sum across, what we end up with is 26,000. Was that difficult? The answer is no, we can do that. So this is the only step, the next one is the only step where we have to be slightly careful. What we want is the actual quantity at the standard mix. So what was the total actual quantity used? If we sum the tonnes, we get 1,000. In fact, it was given in the question. And all we want is to look at that actual quantity in terms of the standard mix. Looking back at the question, we have a standard mix of 70% to A, 20% B, and 10% C. So getting the actual quantity standard mix is very straightforward indeed. So we have 1,000 tonnes. 70% or 700 tonnes relate to A, 20% of 1,000, 200 to B, and 10%, 100 to C. We multiply by the standard price of 20, 30, and 50. So we have 14,000, we have 6,000, and we have 5,000. A total of 25,000. Now, was that too difficult? I'm hoping that what we've done is we've simply followed the instructions that I had up here. Just to recap, we want the total actual quantity, 1,000 tonnes, split by the standard mix. In this case, given by the standard proportions 70, 20, 10%. Finally, we want the standard quantity. Now, what does standard quantity mean? Well, it stands for the standard quantity of actual output. But we have to be slightly careful here. The reason why we have to be slightly careful is that we have a process loss. So we know from the question that the standard quantity was 855 tonnes. And what we need to do is to work out, well, given that we expect to lose 10%, how many tonnes do we expect to put in to get an output of 855? So to calculate the standard quantity, what we want to do is we want to say, well, the standard quantity is going to be equal to 855, but we have to uplift for the fact that we need an additional 10%. You know, for every 10 tonnes in, we get 9 tonnes out. So we simply multiply by 1 over 0.9. That's 1 over 1 minus the loss percentage. That means that the standard quantity is 950 tonnes. All we now need to do is to take that 950 tonnes and split it 70%, 20% and 10% to the individual components A, B and C. 70% is 665 tonnes, 20% is 190 tonnes, and 10% is 95 tonnes. We multiply these by the standard price of 20 and 30 and 50. And what we end up with is 13,300, 5,700 and 4,750. If we sum them across, what we end up with is 23,750. So, we've got all the numbers that we need. Now we calculate the variances, and calculating the variances is very easy indeed. If we wish to look at the yield variance, all we're going to do is compare the top two. Top minus bottom, we've got 1250 adverse because it's negative. If we want the mix variance, the next two, 25 minus 26, is 1000 adverse. And then what we want at the bottom is we want to establish the price variances. Now here we want to look at the price variances individually for each component. 13,200 minus 13,860 comes to 660 adverse. 63 minus this, 420 adverse, and 65 minus this, 390 favourable. So that is how you go about mix and yield. Before we move on, shall we briefly discuss maybe why these variances have arisen? If we look at the price variances, we've got a mixed bag there of adverse and favourable. But if we were to look at mix or yield, why would we have an adverse mix variance? Well, in simple terms, it's adverse because we've used more expensive material. So what I'm guessing is this: we're using more of C than we expected to, and less of B and A than we expected to. That makes the mix more expensive. If we were to look at the yield variance, it's all about output. We have used 1,000 tonnes, where given the output of 855 tonnes, we only expected to use 950. So we've used more tonnes of input than we expected to, given the output. In summary, mix and yield variances are a popular exam question, and you must master being able to bash the numbers out. The mark allocation is normally quite generous. If you can get the numbers out, it's well worth it.